Over the last 100 years, the stock market, the S&P 500, has grown by about 10% each year on average. If you had invested $10,000 in 1980 and never touched it, you would have over $1 million today. The math is easy, so why isn't everyone a millionaire? It is because investing is not free. There is a hidden, painful price that most people refuse to pay, and most people, when they see the price, they refuse to pay it. This is chapter 15 of The Psychology of Money Nothing's Free. In life, we know everything has a price. You pay money for a good dinner or a degree. You don't walk into a restaurant and expect free food. But when it comes to the stock market, many people want the 10% profit without paying anything for it. They want the reward without the stress. The real price of making money in stocks is volatility. This means watching your money drop by 20% or even 50% and doing nothing. It means staying calm when the news says the world is ending and you feel afraid. That is the cost of admission, and you have to pay it over and over for decades. Morgan says most people look at a market drop as a fine, like a ticket for breaking the law. When you get a fine, you feel punished and try to avoid it. But you should see it as a fee, like a ticket to a movie or a theme park. A fee is something you move toward and pay willingly because you know the experience is worth it. When you stop seeing market crashes as a punishment and start seeing them as a fee for building wealth, everything changes. You stop trying to run away. You accept the fear as the necessary cost of a better future. The movie isn't free, and neither are your profits. Let's look at our first story, the price of holding Amazon. Let me show you what paying the price actually looks like with one of the most successful stocks in history. If you had invested $1,000 in Amazon's IPO in 1997, that investment would be worth over $2 million today. It's one of the greatest investments in stock market history, but there was a price to pay to get that much money. Here's what happened to the stock over the years. From 1999 to 2001, Amazon stock dropped 95%. Your $1,000 investment would have shrunk to $50, not $500, $50. In 2008, it dropped 65% during the financial crisis. In 2014, it dropped 25% in a few months. In 2022, it dropped over 50% again. In total, there were 5 huge crashes. In the biggest one, you lost 95 cents of every dollar you owned. Most people could not handle that much stress. They sold their stocks when the price dropped because the pain was too much. By selling, they missed out on becoming millionaires. The people who kept their stock through all those scary drops are now millionaires. They weren't necessarily smarter, they were just willing to feel the pain of losing money temporarily while others weren't. Let's look at our second story. The market always has a price. Morgan makes a very important point about the U.S. stock market. Since 1926, the market has gone up in about 75% of those years. In fact, if you held your stocks for any 20-year period, you would have never lost money. But to get those profits, you have to deal with price drops that happen all the time. Think of these drops as the fee you must pay to make money. The price list looks something like this. A 10% decline happens roughly once a year. A 20% decline happens roughly every 3 to 4 years. A 50% plus decline has happened a few times in a century. These drops are not mistakes. They are a normal part of investing. You cannot avoid them. You have only 2 choices. Stay calm during the drops and earn a high reward over time, or sell your stocks whenever the price drops. If you do this, you will earn much less money. Let me show you this playing out in the most recent and most dramatic way possible. The 2022 bear market, the fee almost nobody was willing to pay. In 2022, the global stock market had its worst year since the 2008 financial crisis. The S&P 500 dropped 25%. The Nasdaq dropped over 33%. Globally, an estimated $14 trillion in market value was wiped out in a single year. The reasons for this were brutal and didn't seem to stop. Inflation at 40-year highs. The Federal Reserve raising interest rates at the fastest pace in history. The war in Ukraine disrupting energy and food markets. Fears of a global recession. Every week brought new bad news. Every month, markets sank lower. The reaction from people was exactly what experts expected. Millions of investors, especially those who just started trading during the 2020 and 2021 boom, got scared and sold their stocks. For example, the popular trading app Robinhood reported that it lost 35% of its active users between 2021 and 2023. These people ran away because they couldn't handle the stress of the falling prices. A study found that in 2022, the average investor did much worse than the actual stock market. This wasn't because they chose the wrong companies, but because they got scared, sold their stocks during the crash, and missed out when the prices went back up. They felt like the falling prices were a punishment, so they ran away to stop the pain. But look at what happened next. In 2023, the market went up by 24%, and in 2024, it went up another 23%. These were 2 years of huge gains right after the crash. The investors who stayed calm and paid the fee in 2022 didn't just get their money back, they ended up with much more than they started with. The investors who sold their stocks in 2022 made a big mistake. They missed out on the growth in 2023 and 2024. Many of them kept their money in cash, waiting for the right time to buy again. They wanted to wait until they felt safe, but by the time they felt safe, the market was 47% higher than when they sold. This is the hardest part about investing. The price you pay is feeling afraid. By the time the fear goes away, the chance to make money is usually gone. Here is the most important part. This will happen again. There will be another year like 2022 where everything drops by 25% or 30%. When that happens, you will have to choose, will you pay the fee by staying calm or will you run away? This chapter transformed my relationship with market crashes. And I mean that literally. Before reading this, every time the market dropped, I felt like something was wrong. It felt like the whole system was breaking and I was losing all my money. My first instinct was to make it stop by selling everything and getting out to protect myself. Now, I see these drops differently. When the market falls by 20%, I don't think I'm losing money anymore. Instead, I think I'm paying the fee. This is simply the price I must pay to get big rewards over the next 10 years. It is like buying a ticket to get into a show. Changing how I think, from seeing it as a punishment to seeing it as a fee, is more valuable than any stock tip or advisor. It's valuable because it changes how I behave. In investing, your behavior is the most important thing. I won't pretend this is easy. It isn't. Watching your savings drop by thousands of dollars feels terrible, but I have learned to live with that uncomfortable feeling. I recognize it as the fee being charged for my future wealth. The price of being wealthy in the long run is feeling some pain in the short run. I have decided that I am willing to pay that price. There are 3 takeaways from this chapter. First, before you invest any money, decide right now that you are willing to pay the fee. Don't wait for a market crash to figure out if you can handle it. Decide now. Tell yourself, when the market drops by 30%, I will not sell. I will stay calm and keep my stocks. I am simply paying the price for my future wealth. Second, stop checking your investments so often. Every time you look at the price, you are seeing small ups and downs that don't actually matter. If you are investing for 20 years, a change in price today is just noise. It isn't useful information. It's just a source of unnecessary stress. Third, remember what this fee actually buys you. It buys you a seat at the greatest wealth-building machine in history, the stock market. By paying this fee, 10% average returns every year over the long term. The massive power of compounding and true financial freedom for your future. That's Chapter 15, Nothing's Free. The chapter that reveals the hidden price tag behind every good investment and shows you that the only people who build lasting wealth are the ones willing to pay it. In the next video, we cover Chapter 16, You and Me. Morgan explains why taking financial advice from people playing a different game than you is one of the most dangerous mistakes you can make. Like this video if it changed how you see market crashes. Subscribe if you've been with this series and tell me in the comments, what's the biggest fee you've paid as an investor? A crash you held through? A drop that tested you? Share your story. It might help someone else hold on. See you in the next one.